This is co-authored work with Thibaut Picard, who is an economist at Banque de France. So understanding how exchange rates impact firms and how firms respond to exchange rate shocks is a central question in international macro. We usually think that currency risk is concentrated in a few major global firms. That's because global firms face currency risk from operating across currencies and countries, and because exchange rates are significantly more volatile than fundamentals. To deal with this risk, these firms trade on average $283 billion per day in foreign exchange derivatives. That's an order of magnitude more than trading goods, and these global firms trade so much, presumably because they face a lot of currency risk. In finance textbooks, we have a theory for this trade, which is that firms hedge to make sure that they have enough cash to invest and say pay their employees, even when the exchange rate isn't favorable. So if we want to understand currency hedging, and certainly if we want to test this standard story, well, we need empirical evidence. Unfortunately, most of the available data and the publicly available data are about gross volumes. With gross volumes traded only, you cannot measure how much risk is being hedged with derivatives, and you certainly cannot test the standard story, which is more subtle and has to do with hedging liquidity risk. In this paper, I'm going to do three things. The first thing is that I'm going to exploit a specific European regulation that mandates daily and contract level reporting for all Eurozone counterparties to a derivatives trade. This is going to give a complete picture of what firms are doing with derivatives. So we access this data through the European Central Bank because these are confidential data. Now, once we have built this data set, we're going to document 4 key facts that are at odds with our current understanding of currency hedging. Fact number 1 is that global firms do face a lot of currency risk, and they hedge it with derivatives, which is reassuring. More specifically, we find that the more currency risk firms face, the larger the fraction of risk being hedged. That's fact number 1. Fact number 2 is that firms are able to trade without posting collateral. And if they do post collateral, it is small. Fact number 3 is that trading costs on these markets are also small for the large publicly listed firms we study. And fact number 4 is that cash positions are uncorrelated with hedging. And so even cash-rich firms, in my sample it would be Louis Vuitton, but you can think of Apple and Microsoft, even these cash-rich firms also hedge. Now, I'll get into a lot more details about why these facts are at odds with our current theories of hedging, but based on the textbook view that hedging is about liquidity, you can already guess that the fact that cash-rich firms hedge a lot is a bit of a challenge for this view. And so the third thing we do is we're going to develop the quantitative risk management model that can explain these 4 facts. The model is going to start from the textbook mechanism. External financing is costly, and firms face limits to how much they can borrow. This is going to give rise to a standard liquidity channel. You want to make sure that you have enough cash, because in a bad spot, while going to equity holders to get more cash is costly, and you cannot just borrow as much as you want. We're also going to add 2 new mechanisms. The first one is dividend smoothing. That's going to help explain why, well, even when you have a lot of cash, you might want to hedge because you value smooth cash flows. And we're also going to add hedge adjustment costs. That's going to be important to match the fact that firms that face less currency risk hedge a smaller fraction of that risk. That's fact number 1. And so we want to match fact number 1, the fact that firms don't hedge all of their risk, even though firms rarely post collateral and trading costs are small, so hedging isn't expensive. Those are fact number 2 and 3. Hedge adjustment costs are going to deliver just that. Now, we make 3 main contributions to the literature. The first contribution is simply to measure currency risk and hedging using derivatives portfolio. So this is a contribution to a very large empirical literature that has tried to understand how firms' outcomes respond to exchange rates. Within this space, I think we're especially close to recent papers that document that there are limits to both operational and financial hedging. So what we're going to do more specifically is we first confirm that firms do not hedge all of their risk. We propose a rationalization for why they do not hedge all of their risk within the model. And we are also able to reconstruct how much risk would they have faced had they not traded derivatives. The second key contribution is that we find that hedging is inexpensive. And over-the-counter markets are quite efficient. So here we contribute to our contribution relative to the literature is to quantify relative to firm fundamentals the importance of three sources of cost: collateralization constraints, covered interest parity deviations, and discriminatory pricing. Our final contribution is to build a quantitative model that can size up the textbook liquidity channel, especially relative to new mechanisms. So here we are especially close to a seminal theoretical literature that has emphasized liquidity management. What we show is that liquidity management explains a fraction of hedging, but cannot explain all of hedging. And so we show that dividend smoothing and hedge adjustment costs together can match quantitative empirical patterns. Now, the plan for today is relatively simple. I'm going to first talk to you quickly about the data. Then I'm going to walk through the 4 key facts. And then I will give you an overview of the model, although because the presentation is 40 minutes long and I want to allow for questions, I won't get into the details of the setup of the model, but I can refer you to the paper. And finally, I'll conclude. So by the way, please interrupt me if you have any question. If we don't have questions yet, then I'm going to start with the background and the data. As I said before, the key empirical innovation of this project is that we build a data set that's based on daily and contract level reporting under European regulation called IMIM. So just to give you a sense of what the data look like, here's a typical observation. Here, Deutsche Bank is a European counterparty, so it's going to report this trade with Carrefour, a French firm. We see what the kind of contract is being used. That's a forward on the dollar. What's the amount being hedged? What's the price? We see that Deutsche Bank is a seller, so that means that Carrefour is buying euro forward against the dollar. And very importantly, we see the collateralization status. This shows us, for example, that Deutsche Bank, which is the reporting counterparty, does not have a margin account. I mean, of course, this is a phony contract because they are confidential, but these are really the key variables we use in this project. We're going to combine this data with consolidated quarterly financial statements from Compustat Global. We focus on Eurozone firms. We exclude financial and real estate firms. And a key thing on top of extensive data cleaning is that EMIR reporting is at the legal entity level. And so we're going to have to consolidate over 10,000 legal entities into Compustat heads. Just to make things very concrete, if you're looking at Apple, maybe Apple hedges with a subsidiary that's called Apple Finance, and maybe Apple Europe will also trade some derivatives and so on. So I'm taking Apple, but we focus on European firms. And so this is really an extensive consolidation work that we carry. In the final sample, we have over 1 million derivative contracts covering over 1,000 public listed firms. So that's quite large for Europe, which is a smaller economy than the US, and so has fewer large public listed firms. And on average, the typical firm in our sample has between 4 and 5 dealer banks. So that's a lot, and that's going to explain partly why trading costs are small. Just to give you a sense a bit more, so here are Deutsche Bank and Carrefour trading together. We would observe the trade between Deutsche Bank and Carrefour because both are in the Eurozone. We would observe a trade between Carrefour and Morgan Stanley US because Carrefour is in the Eurozone. And we would observe a trade between Deutsche Bank and Atacadão, which is a subsidiary of Carrefour. If we observe such a trade, we would consolidate it within Carrefour because the financial statements would consolidate such a trade. However, there's a limit to our data. If there's a trade between Atacadão, the subsidiary in Brazil, and Morgan Stanley, a dealer bank in the US, we would not observe that contract because neither are counterparties of the Eurozone.
So I have a question.
Yes, please.
Can you also see the transaction between the banks?
Yes, although for this project we don't use them, but yes, to the extent that the dealer bank is a counterparty of the Eurozone.
Okay, so how much was this pricing coming from the pricing of the other banks? For example, let's say Deutsche Bank, when they want to intermediate US dollar, they have to borrow US dollar from somewhere else, let's say Morgan Stanley. So maybe Morgan Stanley has a lot of pricing power But for the European banks, they don't have much pricing powers in terms of like let's say the contract level CIP deviations in European banks.
Yeah.
Uh, so in this case, it could still come, the CIP deviation can still coming from, let's say, the monopolistic power from the Morgan Stanley. But you do see that curve for maybe they trade with multiple banks, um, but maybe these multiple banks are source their contracts from just one US bank. Is that
Yeah.
possible?
So that's an important point. I would like to make a distinction. So I think there's two parts for your question. One is kind of like what's the source of these deviations? Which banks are driving the deviations? And this I won't have a lot to say about because I'm not looking at the interdealer market. That would be an interesting, separate question. What I can tell you about is, okay, for the non-financial side, if you interview risk managers, so I interviewed a lot of risk managers for this project. If you ask what Airbus does, say, or Carrefour, what they will tell you, these large firms, is that they ask quotes from 10 to 20, 30 different banks, dealer banks, and they will select the lowest quote. And so what is going on is that the reason why the markups are so small for the firms I look at is that the average number of dealers is 4 or 5. And so banks have to price close to marginal cost. And so I can get into more detail. And so the median markup for over observing my sample is 2 basis points. So that's really small. And what would be interesting is along the lines you suggest, when there's a period of stress, is the markup charged by European banks larger? So that's very interesting, exploring the time series variation. I have not looked at it, but it's very plausible that there will be. Um, that's kind of like, and then there's a question of why would banks accept this counterparty risk? And I think when we discuss this fact, I can give you a bit more of my thoughts on this topic. Just to give you a sense of what the data looks like, so firms mostly trade forwards, which account for 70% of gross notional traded. You see that options and swaps are still non-negligible, both accounting for about 15%. Now, dollar is by far the biggest risk, and together with the dollar, developed currencies account for most of the risk. That's probably, I think that comes in large part from the fact that developed economies tend to be larger. And so firms mostly trade and have economic activities within these large economies. Although in the past few years, you see a very sharp rise in hedging on the Chinese renminbi and on the Hungarian foreign. And so the emerging part has been growing. And finally, you see a third thing that is very interesting is that you see quite a bit of long-term hedging. And so we usually have this prior that firms trade mostly, that these markets are liquid over short maturities. That's partly true, but there's a lot of hedging at over 1 year maturity, which is quite important. Yeah, which I think is quite important and will have implications for the model part. Okay, so now we have a firm grasp on what the data looks like, so we can turn to the facts. The first thing we want to understand is how much firms use these derivatives. So when I talk about currency risk, what I mean is what's the share of cash flow variance that is explained by exchange rates. I mean this in the sense of the factor model, and so I'm going to estimate a factor model. I want to stress that this is very different from an accounting approach that would compute the currency mismatch between sales and costs. The reason why this is very different is because say you're Louis Vuitton and you sell handbags in ruble, what matters is not so much whether your sales in ruble are different from your costs in euros. What matters is say the ruble depreciates. Can you increase the price of handbags without Russian consumers substituting away? And if so, the factor model will correctly detect that you have a small exposure to the ruble, but the currency mismatch accounting would detect a large exposure. So we think that this is really the right way to look at things, and it's really in the spirit of the literature, going back to a seminal paper by Laurent Dumas. Okay, so what do we do? What do we want to do concretely? We want to know how much FX risk do firms face before hedging, and what fraction of that risk do firms hedge with derivatives. The key challenge is that we only observe cash flows after hedging. So say you regress profits on exchange rates and you see a zero. Well, that could be because the firm has very little currency exposure, or it could be because it hedged it all. The standard approach to this challenge in the literature is to build a structural model of profits and how profits depend on FX risk. So there's another seminal literature that looks at this. This requires assumptions on demand, on costs, and on the market structure. We're going to propose a different approach, which relies on much fewer assumptions. And the reason why we're able to get away with it is because we have more data. And so concretely, we're going to measure the exposure after hedging, and then we're going to use our data to reconstruct the exposure before hedging. Let me take an example to make that a bit clearer. On the left-hand side, I'm showing you the exposure after hedging of the firm. So here we obtain it using a factor model. It will be a multi-factor model, but here I only have one factor, where we regress cash flows on exchange rates. Here you see that this firm hedged almost all of its risk, so you detect a zero. Now, using the hedging data, we can reconstruct the exposure of the portfolio to the euro dollar. So for example, here we could compute the euro delta of the portfolio. And here you see that when the dollar appreciates, so when the dollar is stronger, this firm will lose on its portfolio. And when the euro is stronger, it will gain on its portfolio. And if you reconstruct the impact, the factor loading before hedging, you see here the typical exposure of an exporter. What I mean by that is that this is a firm that has sales in dollars. When the dollar appreciates, that's really good for the firm. And when the dollar depreciates, well, that's really bad for the firm. We're going to do this systematically. And the way we're going to do this is estimate this factor model. So in a bit more details, we're going to regress the change in cash flows over changes in exchange rates. What I call B star here is the currency exposure after hedging, and F is the factor price. So here is the yearly change in exchange rate. Unfortunately, although we use quarterly data, we only have about 60 observations per firms. So we're a bit worried that the B star we estimate, our estimation would be underpowered. To try to improve on the naive firm-by-firm regression, we're going to implement a two-step strategy. First, we're going to estimate within industry, in the pooled panel, the average exposure after hedging in that industry. And then we're going to run a firm-by-firm regression, pooling the estimates toward the industry average. So the intuition is that within the aerospace industry, firms should have a similar exposure. And so if you know the average exposure in that industry, you're able to estimate more precisely the exposure of each individual firm. Now, given the exposure after hedging, the only thing we need now is hedging. To do this, we're going to compute the euro delta of each contract that expires within a year. We're then going to sum the delta. So we compute the delta, say for a forward, it would be +1 if you're a buyer and -1 if you're a seller. Because most contracts are forwards, this is actually very close to the truth. And then we sum deltas, weighting them by contract size. We then average this over time, and this gives us a hedging exposure. Note that we only use contracts that expire within 1 year. This ensures that the hedging exposure we compute matches exactly the yearly change in cash flow we estimate in step 1.
So
Now,
can you take one step back? Why are we estimating that? Is it because we don't have currency decomposition of EBIT?
Yeah, so exactly what we want is we want to know what fraction of the cash of EBIT variance is attributable to exchange rates. Even if you knew the sales and costs, the currency decomposition of EBIT, I argue that this is not enough to understand what would be the equilibrium covariance between EBIT and exchange rates. So just to take a concrete example, if you think of Volkswagen, what they would tell you is, if the US central bank, if the Fed tightens, the dollar will appreciate. That's good for our sales because of this currency mismatch, right? But they would also say, and they say in earnings calls, well, then consumers will have a harder time borrowing because the interest rate is higher, and that's a negative demand shock. And so the problem is that having just the currency composition of EBIT is not enough. What you really want to do is estimate this factor model. And so taking a step back, why you need the factor model is to know what share of cash flow variance is really due to exchange rates. Because that, if you were a CFO of a firm, what you would want to hedge is not the currency mismatch. What you would want to hedge is your equilibrium exposure to exchange rates, which is a much more complicated object. And so this is why, by the way, something that an interesting trivia, this is why some firms have very large currency mismatch in trade data, yet have profits that are almost uncorrelated with exchange rates because they're hedged by the equilibrium, adjustments. And this is actually quite common when you look at granular trade data.
Sounds good. Yeah.
Okay, so now we have the fact we have the risk after hedging. We have hedging. So given risk after hedging, if you subscribe hedging, well, if you subtract hedging, you get the exposure before hedging. Okay, so let's look at, I'm going to divide all of these by cash flow variance so that volatile and less volatile firms are comparable. Here, what I show you is that ranked firms on deciles of currency hedging. So 10 is the firms of currency risk before hedging. 10 are the firms that are the most exposed to currency risk, and 5 and minus is the 5 lowest deciles. So you see first that below the median, firms have almost no exposure to exchange rates. That's in line with survey evidence. In surveys, about half of firms say that they have no exposure whatsoever to exchange rates. Now at the top, you see that exchange rates can explain up to 30% of cash flow variance. And even at the third decile, we are almost at 10%. So this is quite a lot, and so you see that currency risk is concentrated in the first few deciles, but can be large. Now, of course, what we're interested in is how much of it they hedge. So hedging is the green bar, and whatever is left after hedging is the light blue bar. What you can see is that first, firms hedge a lot. For the most exposed firms, hedging reduces cash flow variance by over 25% relative to a counterfactual where that keeps everything else constant except hedging. So this is quite large. The other thing that you can see is that the firms that face a lot of risk hedge a large fraction of that risk, but firms that face less risk hedge a smaller fraction. The third thing you can see is that the light blue bar tends to be different from zero, especially at the top. And so in a way, we can reject the hypothesis almost everywhere at the 95% confidence interval, but at the 90% confidence interval for sure, we can reject the hypothesis that risk after hedging is zero. This confirms, when I was talking about the first contribution of this paper, here we confirm a recent literature that was able to detect that the light blue bar is different from zero. Our relative contribution is to reconstruct the dark blue bar and the green bar. Okay, so I guess once you see this, the natural question is, well, what's going on? Why do firms hedge and what's driving this? And so the standard story is, as I said before, there's this liquidity channel. Firms want to make sure that they have enough cash to finance their operations even when the exchange rate isn't favorable. One implication of this is that the marginal benefit of hedging should decrease as firms accumulate cash and are able to self-insure. Because when you have a lot of cash and you're not constrained, well, the likelihood that a quarterly exchange rate shock will lead you to be constrained is quite small. So if you're Louis Vuitton or Apple, you're not constrained. The marginal benefit of hedging is small. We usually think there's another offsetting channel, which is a collateral channel that severely limits hedging. The idea is that anytime a firm trades a derivatives contract, it has to put cash in a margin account, may face margin calls, and that's cash that cannot be used for other productive purposes, such as investing. What this implies is that the marginal cost of hedging decreases as firms accumulate cash and can post collateral. And so the predictions of this standard story are quite subtle, and they depend on the interplay of each channel. Ultimately, it's an empirical question, right? To determine, well, which channel dominates and when. It's very natural to want to evaluate this channel empirically, and so given this, and so our second fact is that firms actually rarely post collateral. You can see here that 60% of firms do not post any collateral. And more generally, 87% of firms have less than 10% of their portfolio that has any sort of margin account tied to it. Now, is 10% large? To answer that question, we're going to compute the value at risk relative to firm liquid assets. What I call value at risk is the margin calls that would occur in a 1 in 25 years exchange rate shock.
Can I ask a quick question? Sorry. Would you have a sense of how this collateral posting varies by the maturity of these trades? Is it true that even for long-term trades, they don't post collateral mostly?
Yes, it's true. For example, if you think of Airbus or Volkswagen, and so these are firms that I interviewed, so I'm quite confident, then they would hedge up to 5 or 10 years in advance and still not post collateral for those contracts. Actually, I would argue that it's more important not to collateralize long-term contracts because you're going to be exposed to the P&L volatility, variation over a longer horizon. And so I think it's a bigger deal, to commit to posting cash in a margin account and face the margin calls over a longer horizon. But indeed, in the data, kind of like you see as an equilibrium outcome, you see that firms are able to trade very long-term forwards on over-the-counter markets without posting collateral.
Thank you.
Nicholas, can I also add to this? So I'm wondering if this is also a matter of selection. And what I mean by this is that there are many small firms in the world that choose to never ever hedge because they know they have to pay these costs. And for them, it's actually binding. Whereas for other firms that we do observe taking on these trades, these costs are essentially nothing. And so, like, how do we think about what you have presented versus the whole universe of the costs of financial hedging? Because in some sense, what we're looking at are the firms that are engaging in this behavior.
Yeah. So that's a really important question. I have two answers to this. The first is a disappointing answer, which is that I don't look at the small firms because I look at public listed firms. That's partly for data reasons that when you consolidate, you want to be really sure that you're attributing the right legal entity to the right head. And that's very hard to do with private firms in my experience. But now, the second answer, I can give you my thoughts on this. Obviously, this is a speculation because I haven't looked at the data for private firms, for like very small firms. I think, so a very strong empirical regularity since the 90s that one of the strongest predictor of both currency risk and currency hedging is international trade and international borrowing. We know from the trade literature that these activities tend to be concentrated in the largest firms. So the top 1% of firms account for 80% of trade. Now, so I think that when you look at currency risk, it makes, in a way, it's obviously an approximation, but I think as a first pass to understand what is going on, focusing on public listed firms will capture most of the risk, especially in European markets where we know these firms are quite mature and there's less, firm dynamism than say in the US or in other countries. So given that most of trade in Europe is done by very large mature firms, I would say that that's reasonable. That's a reasonable approximation. But that's definitely a very important point. Okay, so if we look at the value at risk, so what I mean by value at risk is what the margin calls if you're hit by a 1 in 25 years negative shock over all your currencies. It's very small, under 2% of cash for 93% of firms. Why can that be true? Well, first, you have one thing, which is that a lot of firms collateralize then less than 10% of their portfolio. So that's already division by 10. Now, we also know that a very bad currency shocks, quarterly currency shock, it's about 10%. So what this means is that the value at risk, the margin call, will be 100 times smaller than how much you hedge. So this is why, because firms, so this is why the value at risk can be small relative to liquid assets. Of course, you have some firms that collateralize a lot, and then for them, it would be a big deal. Okay, so of course, if we can be worried that there will be other trading costs. So here we look at two different sources of trading costs, which are covered interest parity deviations and markups. But what I mean by markup is you look at the forward price in IMIR, and you look at the interdealer price for that same 30-second band. And in both cases, we find that trading costs are very small relative to firm EBIT. They're not totally trivial. They're on the order of 0.1% of EBIT. I would argue that this is little, but this is not a zero cost either. This is usually more than the CEO salary, just to give you a range. Okay, so our last fact is that cash is uncorrelated with hedging. This is more or less true just in the cross section without any control. But of course, we can be worried that, well, some firms hedge a lot because they're more risky and hold more cash because they're more risky. So to try to deal with this, we add some controls, first sector and time fixed effects, and also EBIT standard deviation, which controls for risk. What this graph shows is that in the cross-section, cash is uncorrelated with hedging. And the most interesting part is that even cash-rich firms, firms that have 15% of their assets in liquid assets, of their total assets in liquid assets, still hedge a lot. And certainly do not hedge less than firms that have very little cash relative to assets. And we have similar, I think this is relatively, although this is always a bit shocking, this has been known in the literature for quite a while. And this is why people have introduced this collateral channel. The real surprise is that the collateral channel is much weaker than anticipated. And therefore, you would expect somehow the liquidity channel to explain currency hedging. And yet, these cash-rich firms hedge a lot. So, taking stocks, we have two main findings. First, hedging is inexpensive, and over-the-counter FX markets are actually quite efficient. Again, taking Oliver's point for the large publicly listed firms we look at. Now, we also see that the collateral channel is weaker than anticipated, and yet cash-rich firms hedge a lot. To explain these facts, we're going to build a quantitative model, and the kind of questions we have in mind for the model are, well, just how much hedging does the textbook liquidity channel generate? Can it explain most of the data or half of the data? And then if it doesn't explain all of the data, what other mechanisms can? And then what is the value of hedging products to firms? Now I'm going to talk about the model in a bit more detail. If you have any questions, please go ahead. I'm going to give you just an overview of the model because I won't have time in 40 minutes to really set up the entire thing. And I think it makes more sense to really talk about the takeaways. So the model is relatively simple. We're going to have financial frictions. Otherwise, Modigliani and Miller would apply and we would have no hedging demand. So there will be several financial frictions that give rise to hedging demand. And we will have exogenous risky cash flows. A key feature is that the cash flows will be exposed to persistent exchange rate risk. Let me explain a bit more what I mean by that. You have exogenous and stochastic cash flows that are going to face persistent currency risk on profit margins. So a typical micro foundation would be sticky prices. Airbus sells planes in dollars, though they sign a contract 10 years in advance. And so when the exchange rate moves, well, they're going to be exposed to, so if the dollar appreciates, their profit margins will go up. And if the dollar depreciates, the profit margins will go down. What I mean by persistent is that for Airbus, for example, the 10-year exchange rate history would be relevant. We're also going to introduce idiosyncratic risk on sales and profit margins. It's important to have non-currency risk because otherwise firms are able to hedge all of the risk with one instrument. We're going to allow firms to use three financial instruments: one-period risk-free bonds, equity, and FX forwards. Finally, shareholders are risk neutral, which I think is a caveat from the model, but will allow us to be directly comparable to the structural corporate finance literature. Okay, so I said I wouldn't go into the math of the models, but I still want to highlight the three main mechanisms. We're going to start from the standard liquidity channel. That's going to generate hedging demand that depends on your liquidity. So borrowing is limited and equity issuance is costly. What that means is that when you face adverse exchange rate shocks, you might want to hedge because, well, if you're in a really bad state, going to shareholders and asking for money is costly, and you cannot just borrow more because borrowing is limited. Now, as we're going to see, this does not generate quite enough hedging demand. So we're going to add a second mechanism, which is dividend smoothing. What this means is that firms might care about smooth outcomes in and of themselves, and that's going to generate hedging demand even for cash-rich firms. It can capture several micro-foundations in reduced form. One is that investors are learning about fundamentals, and it's easier to learn about fundamentals when there's no exchange rate noise. Another is that managers have skin in the game and they're risk averse. If they miss an earnings target or they miss a dividend target, then it's costly for them personally, and they will want to hedge. The third key friction is hedge adjustment costs. They're going to generate deviations from optimal hedging ratio. Here I have quadratic adjustment costs, and they're going to help explain why firms do not hedge all of their risk. These adjustment costs capture governance frictions. So for example, the board usually votes on what products you can use, what hedging target you can use, and going back to the board, well, can only be done every so often. The other explanation for hedge adjustment costs is that firms frequently use long-term forwards, and hedge accounting rules make it costly to unwind those trades. That's really like textbook adjustment costs. Okay, so just in terms of matching moments, how do we do? Well, if we do the standard story and we target standard parameters, we can see that firms do not hedge enough. In particular, what I mean by risk level, high is the top decile of risk exposure, and low is the decile just below. And we know that firms that are the most exposed, we saw that they hedge 80% of the risk, and that firms that are less exposed hedge about 30 to 40%. You can see that the liquidity channel does not generate nearly enough hedging demand. Of course, the baseline model will generate enough, and the idea is that dividend smoothing will allow you to match the fact that firms hedge more than for pure liquidity reasons. But at the same time, hedge adjustment costs will make sure that not everybody hedges all of their risk. So in a way, the model is quite straightforward, right? Liquidity will always lead you to hedge more, dividend smoothing will always lead you to hedge more, and adjustment costs will always lead you to hedge less. What is interesting is that because the model is quantitative, we can highlight some stories and rule out others. And so here we can rule out a world in which only liquidity, the textbook story, would explain currency hedging. Now, there's still a question of, well, are hedge adjustment costs any good? To understand this, I'm going to argue that hedge adjustment costs can generate plausible demand elasticities. What I mean by that is we can ask, how does hedging demand respond to deviations from covered interest parity? Concretely, what I mean by that is if CIP deviation increased by 10 basis points, how much does notional to assets decrease for a firm that is long? You are an exporter, you buy euro forward against the dollar, CIP deviation increase, that's a cost for you. Do you hedge less? And if so, by how much? In the model, without hedge adjustment costs, the demand is very elastic. A 10 basis points increase in CIP would decrease hedging demand by 400 basis points. With adjustment costs, it's 2 orders of magnitude below, about 8 basis points. In the data, estimates for this elasticity, for this response, range from 1 to 10. So we estimate it in the paper, in an appendix. We propose an identification strategy. And there's a recent paper by Hélène Rey and Asioglu-Oke and co-author that argue that the elasticity is a bit higher. So we argue that the takeaway is just that the elasticity of hedging demand to costs provides external validation for adjustment costs. Finally, I'm going to go relatively quickly over this, but I want to argue that hedging gains are an order of magnitude larger than trading costs. So if you focus on the right, total gains, you see that it's 1%. And then argued in the empirical part that, well, trading costs were on the order of 0.1 to 0.2% of firm profits. So here we're on the right order of magnitude. And then we can try to decompose where do these costs come from, this gain come from. You have a lot of gains from just smoothing. Then you also have gains from financing costs. And you have gains from exit debt. What I mean by that is that there's exogenous default in the model. So this is not an innovation of the model. Here we take it from the literature. If you could not have access to derivatives, then you would need to lever up more to smooth outcomes. And that's costly. Finally, there's hedging adjustment costs, hedging costs that come from adjustment costs. Okay, so I have 2 minutes. So I just want to conclude relatively quickly. If we take a step back, global firms are extremely active on these markets. We know they face a lot of risk. There's this gigantic financial market that's dedicated to hedging risk in principle. What we do in this paper is we provide new empirical evidence on this market and a quantitative model to explain the evidence. We document 4 key facts that challenge our current understanding of currency hedging that's based on a trade-off between liquidity and collateralization. And we're going to propose a quantitative model that can rationalize these facts based on simply dividend smoothing and adjustment costs. The key insight from this paper is that derivatives offer a laboratory to study currency risk and financial frictions. What I mean by that is that derivatives only impact cash flows, and this impact only depends on exchange rates. So as we discussed before, for example, Airbus and Volkswagen use 5-10-year products. That tells you something about the term structure of their risk. Probably they face very long-term risk. This is something that's very hard to observe otherwise. Similarly for financial frictions, because derivatives only impact cash flows, we're able to tease apart from financial frictions that are very similar: dividend smoothing and external financing costs. This opens broader questions, which is what is the supply side implications for firms and banks of having more derivatives products, more complete markets. In the model, I have exogenous cash flows, but maybe there's an impact on product market competition. Likewise, in the model, I have an exogenous CIP deviation or trading cost. but perhaps providing insurance against aggregate risk is costly for the intermediary. And we already hinted at during the questions that maybe some banks are driving CIP deviations. And so there's a question, how can banks and other financial intermediaries even supply insurance against currency risk? How does that function? I think there's a lot to explore in that space.
Great. Thank you very much, Nicolas. Great paper, great presentation.
I just have
Yeah.
one very short question to ask before we move on. Do you observe anything other than exchange rate contract? Suppose I'm interested in whether firms are also hedging interest rate risk or oil price risk following similar behavior, or is exchange rate special at all? Can you say something about that?
Yeah. So I have kind of like a simple-minded answer, which is in the data set, I observe everything. So in principle, I observe all derivatives. Now then, because of my personal bias, I looked at exchange rates first. I also think it makes sense because then I leverage a lot the cross-section of industries and the cross-section of countries, which is hard to do with only commodities where the risk is concentrated in a few industries. But in principle, I think there's a lot to do, especially in the product market competition, in the commodity space, there's a lot to do, I think, there. So I think this opens the breach for an agenda, but then there's a lot to explore in different dimensions of traded risk.
I see. Cool. Thank you.
Okay, so next we have Umang from Iowa presenting his job market paper, Synthetic Dollar Funding.
Great. Thanks, everyone, for being here. Thanks for having me on. My name is Umang. I'm from the University of Iowa, and I'll be talking about synthetic dollar funding. We discussed a little bit of this during Nicolas's presentation, so I think I'm going to give you a bit of deep dive into how banks source US dollar funding in the foreign exchange markets, how that affects their lending behavior, and certain macro level implications. The motivation is quite straightforward, which is that US dollar is the defining, US dollar dominance is the defining feature of global economic system. We do know from a very large literature that firms, not only in the US, but globally, they very frequently need access to US dollar liquidity in the form of trade credit, working capital loans, sometimes even long-term debt, because the vast majority of cross-border transactions are dollar denominated. And the primary source from which these firms obtain these dollars are large global banks, which are the key intermediaries in these markets. An interesting feature of these markets is that non-US banks like Deutsche Bank, Barclays, Nomura, these supply more than half of all the dollar credit globally. The time series chart here shows you that non-US banks, headquartered in various different countries, currently supply about $14 trillion of US dollar denominated assets, which I think is really interesting because these banks do not have a large deposit franchise in the US. And therefore, the number of funding markets that they can use to support these kinds of dollar assets is quite limited. And therefore, it is important for us to understand what kind of funding markets banks rely on to be able to support such large amounts of dollar assets. And that's really going to be the focus of this paper. We're going to concentrate on short-term funding markets because short-term funding markets are one of the most important sources of dollars for large global banks. Broadly speaking, there's two types of short-term funding markets that banks use. The first one is the more traditional wholesale funding market, where banks issue instruments like repos, commercial paper, certificates of deposits to raise dollars between 7 days to 3 months maturity. The main investors or providers of dollars in these markets tend to be money market institutions. Think of Vanguard, Fidelity, BlackRock, and the like. Now, these markets are very large and they've always been very important. But since the financial crisis, many of these markets have become a little bit more difficult to access, particularly by non-US banks. And I'll talk a lot more about what these constraints are. But these markets in general face a lot more limits in how much dollar liquidity they can provide to non-US banks. The second kind of market that has grown a lot more is the so-called synthetic funding market. The way this market works is that banks first raise a foreign currency, like the euro or the yen, and then enter into a foreign exchange swap to obtain dollars temporarily. Swaps are derivatives, which is why this form of borrowing is also known as off-balance sheet. Now, we are an international finance audience here. I think most of us understand the cash flows in a swap, but just to make sure that we're on the same page, think about two counterparties. You have a borrower bank, let's say Deutsche Bank, and a lender bank, let's say JP Morgan. Okay, they enter into a foreign exchange swap. At time T, Deutsche Bank is going to provide a certain amount of euros, let's say Q, against which it receives a certain number of dollars, which is Q multiplied by the current spot rate. At maturity, that's T plus 1, they're going to reverse this transaction. Deutsche Bank gets back the euros that it had provided to JP Morgan, and this time returns dollars, but Q multiplied by the forward rate. Okay. Both the spot and the forward rate are known at the inception of this contract. So there is no real price risk. It is fully hedged from exchange rate perspective. And the difference between forward and spot rate is known as swap premium. That should, in theory, be nothing but the interest rate differential between dollars and euros, because one counterparty gets to keep the dollars, the other counterparty gets to keep the euros. They're essentially compensating each other for the interest rate differential. Now, this market has grown quite substantially in the last 20 to 25 years. One way to see this is the outstanding notional that non-US banks hold in the form of US dollar denominated swaps. This chart is from a recent report from the Bank for International Settlements, and it shows that the total amount of dollar debt that comes from swaps is pretty large. It's close to $40 trillion. Of course, this is based on notionals, which is not the same as exposure, but still it gives us a sense of how quickly this market has grown, especially since the financial crisis. Now, despite the fact that the swap market has become such a large component of dollar funding, there's a number of fundamental questions that remain unanswered in the literature. First such question is, what exactly is the role of swaps in banks' dollar funding portfolio? Now think about it this way. We're talking about very large global banks. Okay, they usually have sources of US dollar funding which are much cheaper than swaps. You're talking about Deutsche Bank potentially being able to raise dollars at a much lower rate than going to the foreign exchange market by issuing repos and commercial paper. Why would it go to the swap market to raise dollars, which tends to be much more expensive? And this question is particularly relevant in today's context. We do know that many of the US regulations after the financial crisis have tried to limit the exposure of local investors like money market funds to non-US banks in order to prevent them from undergoing huge amount of default risk. More recently, there's been a lot of concern in the financial media that dollar funding markets themselves could be potentially used as a negotiating tool in the evolving tariff policy. So it becomes important to get a better grasp of where swaps fit in. Do they help banks reduce some of these traditional wholesale funding constraints, or they work pretty much independently as their own source of funding with no real linkage to these wholesale funding markets? The second question is going to be about prices. What is the impact of banks' demand on swap prices? We're going to specifically talk about covered interest parity deviations. We do know that covered interest parity deviations is one of the most interesting puzzles, let's say, in the foreign exchange markets. In theory, the cost of borrowing dollars in the synthetic markets should not be very different from the cost of borrowing dollars in wholesale markets. And that condition gets pinned down by what is known as cross-currency basis, which should be very close to zero. In practice, the cross-currency basis has persistently been negative since the financial crisis, which means synthetic dollars are actually more expensive than wholesale dollars. Of course, this has not gone unnoticed. We have a very large literature, and many people here in the audience have contributed to it, which shows that these cross-currency bases, they emerge from a number of sources. They have real effects in the form of cross-border investments, so they are important to study. What is missing in the literature, though, is causal evidence on whether this particular demand from banks for short-term dollar funding is a contributor to cross-currency basis, and if yes, to what extent. That quantification itself is important because it helps us understand the extent to which funding market frictions can ultimately lead to an impact on bank lending. Let's say if swaps were perfectly frictionless and banks could always use swaps to raise dollar funding without much of a price impact, you would probably not see much of an impact of wholesale dollar decline on bank lending activity. But if there is a price impact, and we do know that these markets are less efficient, then that's going to moderate the extent to which swaps are going to be useful. So that's where this quantification becomes important. Now, the research on these fields has typically tended to look at wholesale and synthetic funding markets in isolation. What I'm going to do in this paper is connect the two markets. And the way to do this is to overcome the key challenge of lack of quantities data from the swap market. Nicolas's paper, of course, looks at the data from IMIM markets. I'm going to use a different data source, which also gives me a quantification of the use of these foreign exchange swaps. And using those data, I'm going to jointly study how banks make use of wholesale and synthetic funding markets and show you three things over my remaining time today. First, I will show you that banks increase their demand for synthetic funding when they face decline in wholesale funding markets. Why do they face a decline in wholesale funding? It's because they run into these occasionally binding constraints in the availability of wholesale dollars, in response to which they increase the use of swaps. To show that result, I'm going to leverage a regulatory reform, a natural experiment, where in 2016, there was a very large decline in the availability of wholesale dollars to banks because of a large regulatory change which impacted money market funds in the US. In response to that, I will show you that banks significantly increased the use of swaps for raising US dollar funding. Now, this finding has an important implication, which is that there is a part of swap demand which is driven by quantitative restrictions that banks face in the wholesale funding market. Typically, we think about banks as very large, agile institutions that should always be able to source the cheapest form of funding. That's not always true. They're going to use swaps, even though swaps are typically more expensive, because they're not able to scale up wholesale funding to the extent they need it, which creates this demand shift in the favor of swap markets. And the second implication, a little bit more from a regulatory perspective, is that to get a sense of the full extent of dollar debt that banks have, we have to look beyond the on-balance sheet liabilities. Swaps are off-balance sheet, and the amount of dollar debt that banks have using swaps does not usually get captured if you only look at the on-balance sheet liabilities. So that's an important data contribution that this paper has. The second thing I want to talk about today is that when banks increase their demand for swaps, it has a very sharp impact on swap prices, which effectively makes synthetic dollars more expensive. Now, we already have a large literature which shows that swap markets are inefficient in the sense that swap arbitrageurs, the JP Morgans of the world, they do face additional costs of supplying dollars in the swap market. These costs come from various sources. There's regulatory leverage ratio cost, there's balance sheet funding costs, there's also market power, which we know from more recent literature, all of which put together create an upward sloping supply curve. What I'm going to show you is that when banks increase their demand, which is a rightward shift in the demand curve, that turns the cross-currency basis more negative. Quantitatively, for a 10% increase in banks' demand, the basis turns more negative by 7 basis points. To put that number in perspective, the average cross differential here is about 26 basis points. So we're talking about a pretty meaningful increase in the relative cost. And I'm going to show this in a causal fashion. I will make use of wholesale funding constraints that banks face to instrument for this swap demand and thereby show this price impact. This is going to be an important demand side channel, which complements what we already know is a costly supply side argument in the swap market, which effectively raises the intermediation cost of banks. Dongchun, did you have a question?
Yes. So, so do you have heterogeneity across different banks? Are there domestic, like only domestic US banks, or there will be differences between US versus European banks?
Yeah, so I do have differences at the country level. I do not have differences at bank level within each country. So I really cannot tell you anything about Deutsche Bank versus BNP Paribas, which are two European banks. But I will be able to separate out US banks from this equation, which is, I think, a big source of heterogeneity in these questions. So I'll talk a little bit about how I do that as well. Great. So now at this point, what we would have seen is that banks increase the use of swaps to raise dollars when they face wholesale funding decline. That has a price impact in terms of cross-currency basis. These two frictions are jointly going to have certain macroeconomic implications. I'm going to show you that it is precisely when banks face tighter wholesale funding frictions and expensive synthetic funding that they increase the drawdown of central bank swap lines, which is an emergency facility to provide dollar liquidity globally. I'm also going to be able to connect these frictions eventually to bank lending. Not all banks have access to emergency facilities like swap lines. At least for some banks, it might directly hit their dollar lending business. To do this exercise, I will calibrate a very simple model of bank lending. I'll not have the time today to explain the model in detail, so I just want to summarize that part in this picture so we have a good sense of what the implications are. Imagine there's a representative bank which typically lends US dollar credit to certain end borrowers, firms, funds, whatever it may be. The dollar lending doesn't have to be only in the form of loans. It could even be within the swap market in the form of long-term swaps. So there is a dollar supply that's happening from the bank perspective. Generally, the bank wants to raise wholesale dollars from money markets. That's usually cheaper, so it's the first source of dollar funding for banks. But when it faces a decline in dollar funding from wholesale markets, it goes to the swap arbitrager to raise dollars synthetically. When it does that, it ends up paying an extra cost, which is the cross-currency basis. The extent to which the bank will be willing to pay this cost crucially depends on the marginal revenue that the banks can make on these dollar assets. So in equilibrium, you have a point where the marginal cost, which is the cross-currency basis, intersects the marginal revenue that banks can make, beyond which it's no longer profitable for banks to use the swap market to raise US dollar funding. What will they do at that point? They could either cut down lending or they could increase the cost of dollar credit by pushing it down to the end users. My objective here is to try and quantify using counterfactual experiments where this threshold lies. I find that this threshold is at about 20% decline from current wholesale funding, which gives us a sense of how much slack there is in current wholesale funding markets. If US regulators, for example, were to further tighten the availability of wholesale funding, they could go up to the extent of 20% greater decline before it actually begins to hurt the availability of dollar credit globally. So that's the kind of counterfactual contribution that comes from this exercise. All right, so
I
that's
have a question. So how do you calculate cross-currency basis?
How do I calculate it? I use the OIS rates for both the currencies, dollar and the foreign currency, and then I use the swap premium that's available from Bloomberg.
Okay, so it is not affected by the money market funds.
It is not because so I'm stripping out credit risk here. If I had used LIBOR, for instance, I would account for credit risk, which might correlate with the money market fund availability of dollars. Yeah. Okay, so let me start with a little bit of institutional background and a bit about my data. In the paper, we're jointly studying both wholesale and synthetic funding markets. So each has its own data source. For wholesale funding, I'm going to focus on money market funds. These are Vanguard Fidelities of the world, which lend well over $1 trillion to non-US banks, but they're also constrained in various ways in how much more banks can borrow from them. The main objective is to preserve capital. So I know a lot of us might have access to certain accounts which also provide money market fund services. If you notice the kind of returns they provide, they're not very far away from treasury returns. They tend to be a little bit more than that, but they are not very risk-taking institutions. They really want to preserve capital for their end investors. And that's why they're called money market, because they essentially work like deposits, just pay much higher interest rate compared to deposits. Now, one another advantage of focusing on these funds is that we have very granular data available. At a monthly frequency, money market funds are required to disclose their entire portfolio on the website of the Securities and Exchange Commission. It's freely available. Anyone can access these data, and we can see the granularity here. For example, we can exactly see how much Vanguard is investing in Deutsche Bank securities, interest rates, maturities, and all other parameters. Now, what makes these institutions constrained? Why can they not lend the entire, why can they not meet the entire dollar demand of banks? There's three main reasons. Increasingly, these funds are subject to investor outflows, and that's because of the way their structure has changed over time. I'll talk a little bit about what that change of structure looks like in the form of the regulatory reform, but these funds now provide much less stable source of funding for banks than they used to before the financial crisis. Secondly, these funds are also subject to concentration limits. So regulations prohibit money market funds from lending more than 5% of their assets on unsecured basis to any individual borrower other than the US Treasury. And therefore, there is an explicit limit on how much these funds can lend. Typically, these funds maintain much lower threshold than what this 5% limit dictates. These funds are also usually very sensitive to the credit rating of borrowers. Even if a bank undergoes a small change in credit rating, funds tend to be very sensitive to that, which limits how much and which institutions can actually borrow dollars from these institutions. Great. Now, the second part of our data exercise is going to be to look at swap markets. Swaps as a product is very straightforward. It's just like a collateralized revolving credit. And in terms of balance sheet implications, if you are a foreign bank, let's say Deutsche Bank, you're lending US dollars, which is your assets, you typically don't have equivalent dollar liabilities. You will first go to your local currency, let's say the euro funding market, and then enter into an off-balance sheet swap to obtain dollars for lending purposes. Because swaps are off-balance sheet, very hard to observe quantities data from any standard data source. So my data source here is going to be a settlement agency. Settlement agencies are like clearinghouses, essentially. They facilitate swap trading. And in the process of doing that, they collect a lot of data on who is actually trading these products, what kind of currencies are involved, maturities, and other economic characteristics. The largest of these agencies is called Continuous Link Settlement, or CLS, which allows me to observe at a daily frequency the amount of dollars borrowed or lent by different types of institutions against a panel of currencies and different tenors. It covers between a quarter to a third of the market, so it's one of the more representative data sources, which is also accessible more broadly to the research audience. There is a limitation of the data set, and we briefly discussed this, that I do not observe individual entities, and therefore I cannot really talk about bank level heterogeneity here. That's not going to be a concern for identification. I will show you that I'm going to make use of granularity of money market funds data to construct my instrument for swap demand, but I think there's still questions that remain unanswered despite this data source being otherwise much nicer, in that we cannot really talk about differences within a country's different types of banks in the way they use swaps. All right, so a few stylized facts before we get into the main regressions and our hypothesis. Here is a time series of the total amount of dollars borrowed by banks in the swap market against all other currencies put together. I've aggregated this to a monthly frequency, and positive numbers here indicate dollars borrowed and negative is dollars lent by banks. There's three main takeaways I'd like you to have from this plot. First, it's a huge market. Even in my sample, we can see that there are months where banks have borrowed well over $1 trillion in the form of synthetic funding, which highlights how important it is to large banks' dollar funding requirements. The second takeaway is that it's a very short-term market, especially the fact that banks are borrowing dollars for almost exclusively for less than 1 month in tenor. And to some extent, they're also doing maturity transformation here within the swap market by lending out dollars for 1 month to 1 quarter or more than 1 quarter in tenor, which is the green and the blue bars that you see below the zero line. Who are they borrowing from? They borrow from non-dealer banks, for example, Northern Trust Bank, or even Citadel, which is not a bank, but it parks its excess dollar liquidity in the form of swaps to earn the cross-currency basis. Who are they lending these dollars to? Mainly other end users like funds, non-bank financials, and corporations. And the third interesting takeaway here is that when interest rates go up, banks actually reduce the use of swaps for dollar funding. And that we can see in the last 2 years of my sample period. Why might that be the case? One hypothesis is that at higher interest rates, maybe the overall demand for dollar credit goes down, so you just need less dollar funding. But that's not what's happened. What has happened is that at higher interest rates, households move their savings from checking accounts to money market funds to earn higher interest rates. And that, if you view from the lens of my story, exactly increases the availability of wholesale dollars for banks. They have less need to rely on swap markets to raise dollar funding. And we can see that in the raw data itself. Great, so we're going to test that as our first research question. What is the role of swaps in banks' funding portfolio? The short answer is that banks use these swaps to offset wholesale funding declines. Okay? The specification here is very straightforward. We're going to look at the changes in synthetic dollars that banks hold against every currency C and month T on changes in the availability of wholesale dollars proxied by money market fund holdings, controlling for assets, gross volumes, prices, macroeconomic variables, and progressively adding fixed effects. And we can see across these four specifications, there is a strong negative relationship between the availability of wholesale funding, which is money market fund holdings, and banks' use of synthetic dollars. For a standard deviation decline in money market fund holdings, we're looking at synthetic dollars increasing by about 23%, which is a meaningful substitution. This is a correlation, of course, and one of the, let's say, drivers of this relationship could be that banks are simply choosing the cheaper of the two funding products. So if there is a lot of time series variation in the relative cost of synthetic and wholesale dollars, maybe banks are just opting for the cheaper product, and so you should just expect a negative correlation regardless of quantitative constraints. What I want to impress upon you is that this is actually largely driven by quantitative restrictions that banks face in money market fund holdings, which leads them to use swaps. And to do that, I'm going to make use of a natural experiment, which is the 2016 Money Market Fund Regulatory Reform. So what is this reform? In 2016, the SEC wanted to implement a series of changes to the way money market funds in the US operate, with the objective of improving their resilience to sudden liquidity shocks. In 2008, we already had lots of money market funds that went under because of investor redemptions. SEC doesn't want that to happen again, so they wanted these funds to institute change in the way they operate. Some of these changes included moving away from fixed net asset values to floating net asset values. They also had to introduce redemption gates. They had to introduce liquidity buffers, all of which impacted the so-called prime money market funds. These were money market funds that lend mostly to banks. Okay? The reform was obviously well-intentioned, but it did have a negative consequence, which is that end investors who were putting money in these funds, they withdrew a large amount of investments in a very short period of time. In the 6 months following the reform, these investors withdrew more than $250 billion, which directly impacted the banks which were borrowing from these funds. So here's a chart which shows banks headquartered in different countries. They all lost a pretty substantial chunk of wholesale funding in the 6 months following the reform compared to 6 months before. So this represents a large exogenous decline in the availability of wholesale funding for banks. And then based on this, we can see what they did in the swap market. Did they increase the use of swaps for raising US dollars? Okay. I'm going to throw this into a difference in differences framework. In my framework, we have treated units, which are banks. They were directly hit by the reform in the sense of availability of wholesale funding. And I'm going to make use of other users of swap markets, corporations, funds, non-bank financials, which also use swaps, but they were not impacted by the reform because they were not borrowing from prime funds to begin with. So their use of swaps should not be related to this reform as much as the use by banks. Here we have a very standard two-way fixed effects model. We're trying to understand what's the impact of this reform on the treated sector, which is banks, in the 6 months following the reform. So real time here measures each month after the reform implementation, keeping in place sector times currency and currency times time fixed effects. And what we observe here is that once this reform was implemented in month 0, there was a large and persistent increase in banks' use of swaps for dollar funding. It wasn't driven by pre-trends, and therefore we can lend this a causal interpretation that banks did use swaps to raise US dollar funding. Now, one question that might come to your mind is, why do banks have to go to this very expensive swap market? Swaps are expensive by between 25 to 50 basis points. Why can't they just pay more money to these wholesale funding markets, money market funds, and ask them for more capital? And the key reason for that is that money market funds tend to focus on capital preservation as their primary objective. There was a time before 2008 where many of these funds were lending to relatively less creditworthy institutions, and they were chasing very high yields. That behavior has largely dissipated after the financial crisis. So today, if a bank was to offer very large interest rates to these money market funds, that will not automatically incentivize funds to increase its lending to banks. And that's something we can test directly in the data. Here I have a security level analysis where I can look at the interest rates that non-US banks pay on the wholesale borrowing they get from money market funds as a function of the amount that they're borrowing, the maturity of these instruments, and then keeping in place a whole set of fixed effects. And what we observe here is that the interest rate does not seem to react very strongly to the amount that banks are borrowing from these funds. On the other hand, as a contrast, the maturity definitely plays a much bigger role. As banks increase the maturity of their borrowing from money market funds, they do charge higher interest rates, but not so much in the case of amount, which kind of highlights that these funds try to limit how much they're going to lend to these banks in order to prevent overexposure to risky institutions. All right, so now we're going to look at the second part of the paper, which is the price impact of banks' demand for swaps. Okay, so the idea here is to quantify how much the CIP deviations change in response to a given shift in banks' demand for swaps. What we know from the literature is that arbitrageurs in the swap market, the JP Morgans of the world, they do face higher regulatory costs of supplying swap dollars. They also exercise market power, as we know from some of the more recent work. Ultimately, what all of this means is that the supply curve slopes upwards in the swap market. And the question here, from an empirical perspective, is what is the impact of a demand shift on the relative price of swaps versus wholesale dollars? Okay. We're going to run into the standard identification challenge here. Prices and quantities are simultaneously determined, so I cannot simply regress changes in prices on changes in quantities. I need an instrument that can shift the aggregate demand of banks, swap demand of banks, independently of prices or confounding factors. And that's exactly what we'll get by using shocks that banks face in the wholesale funding market. So the endogenous regression here that we're kind of trying to estimate is how does the cross-currency basis change in response to the aggregate swap demand, okay? Let's break down the aggregate swap demand of banks into the swap demand of individual banks. So the I here indexes individual banks outside of the US. Now, we are going to apply a demand system asset pricing approach to convert this bank level swap demand into three components. The first component is the price itself, which is exactly what generates simultaneity bias. The second component is some kind of macroeconomic or general factor which affects all the banks. And if you don't control for these, it generates omitted variable bias. It's the third component, the UIT, that we're really interested in. That's the idiosyncratic residual, or the quantity of swaps that only bank I will borrow because it is unable to raise additional wholesale funding that it needs from money market funds. Okay? And this component is going to vary by different types of banks, which generates cross-sectional variation in wholesale funding shocks experienced by different banks, even in the same country at the same point in time. And the source of these shocks is going to be the institutional features of money markets, for example, concentration limits. This is not going to be correlated directly with the pricing in the swap market, which is precisely the exogeneity condition we need to be able to use this instrument. The way to extract these shocks and construct the instrument is to use the granular instrumental variables, or the GIV framework of Grabix and Nguyen. The way this works is that we will first construct the instrument. I'll walk you through the process in the next 2 to 3 minutes. And then I will show you where these shocks are really coming from and hopefully persuade you that these are indeed exogenous to anything else that might swap prices independently. Okay, so there's two broad steps here. First, we want to extract bank-level idiosyncratic shocks to wholesale funding that emerges from money market funds. This is a very straightforward exercise. We first start with delta YIT, which is the change in money market fund investment flows month on month in bank I in month T. This is all scaled, so think of it as percentages. In second step, we're going to subtract the common change that all banks in that particular country experience. So think of it as a time fixed effects regression, and we take a residual from that. What this really means intuitively is that we're trying to get rid of the average change in money market fund holdings across all the banks and looking at the cross-sectional difference across different banks in the same country. Now, this cross-sectional difference is not exogenous enough. It could come from a number of sources, which can be endogenous. So we extract these common factors, the first three principal components, which explain the bulk of common variation in money market fund holdings across these banks. What is the intuitive interpretation? PC1, for example, relates to interest rates. When interest rates move, naturally you would expect some change in money market fund holdings, but it could affect different banks differently because they have differential exposure to interest rates, which is exactly what beta I1 captures. Likewise, you have other principal components, and when we run a bank-by-bank regression on these principal components, we are left with one residual called CIT. That is the bank-level residual or bank-level idiosyncratic shock to wholesale funding that is not driven by common time trends or by common factors that affect all the banks in a particular country. Okay. Now, we don't want a bank-level shock because our endogenous variable is the sector-level swap demand, so we have to aggregate it somehow. The way to aggregate this is to use the size of these banks as a weighting scheme. The logic here being that, let's say, Deutsche Bank is a much bigger bank than Commerzbank, both of these being German banks. But shocks faced to Deutsche Bank should matter a lot more in the aggregate swap quantities compared to shocks faced by Commerzbank. So using the size of these banks, we aggregate these bank-level CITs into a country or currency level ZT. That becomes my instrument, which I call excess wholesale funding. Okay. All right. So why is this a valid instrument? What is it about this setting that makes it legitimate? First is that these idiosyncratic shocks, the ZITs, they're arising from institutional features of money markets. I'll list two of these features here, and this is something we can look and see in the data itself. First is that there is cross-sectional variation in the ex-ante exposure to money market fund flows. Example, Vanguard lends to, let's say, 3 European banks out of 10. If Vanguard suffers some kind of outflows from its own end investors because it increases the fee structure, that affects only 3 banks and not the remaining 7. Think of it like a shift share instrument where you have this cross-sectional variation in wholesale funding due to a reason that has nothing to do with swap pricing independently. Second reason is the differential proximity to the concentration limit. These are exogenous limits set by regulators, and when banks are closer to this limit, they face larger funding shocks compared to banks that are further away. And this approach particularly works when you have a concentrated industry, such that these idiosyncratic shocks do not wash out in the aggregate. And that's the case with money market fund lending to banks. There's only few large global banks in every country, and therefore shocks faced by some of those do aggregate into macro level fluctuations, which is exactly what we're going to try and exploit here. Okay. In the first stage, then I go ahead and test the relevance of my instrument, which is excess wholesale funding. I find that it is a strong explanatory variable in the context of my endogenous variable, which is the synthetic dollar funding. It is a statistically strong instrument, but reassuringly, the sign in the first stage is negative, which means that when banks have excess wholesale funding, they reduce their demand for swaps. That is precisely consistent with the story I've been laying out so far, in that these two funding markets act as substitutes to each other. I also confirm that the instrument itself is not correlated with some of the observable confounding factors that you can think of. You asked a question about US banks, for example. I find that my instrument is not correlated with the wholesale funding that US banks receive. And the key reason for that is segmentation within the money market fund industry. Money market funds do not treat all of these borrower types as the same. One way to think about that is that when these non-US banks face wholesale funding shocks from money market funds, that does not naturally spill over to US banks. So here in this table, I show that when money market funds face outflows, they reduce their allocation to non-US banks, but that money does not go to US banks. In fact, it goes to the Treasury, which does not participate in the swap market directly. So that gives me an exclusion in the form of these funding shocks being unique to non-US banks, not correlated with what US banks face at the same time. And there's other exclusion restrictions that I'll talk about more in detail in the paper. In the interest of time, I'll move on to the second stage here, which is to look at the causal impact of banks' swap demand on cross-currency basis. Okay. In the first stage, we use the instrument for the synthetic dollar demand. Here we'll use this instrumented variable and look at the impact on changes in cross-currency basis. In the first 3 columns, I'm looking at the first principal component of the basis at 3 different tenors, 1 week, 1 month, and 3 months. And then I have the 1 week and 1 month separately. Across these 5 columns, what we observe is that when banks increase their demand for synthetic dollars, the cross-currency basis turns more negative, which means that synthetic dollars essentially become more expensive compared to wholesale dollars. Economically, for a 10% increase in demand, the 1 month basis turns more negative by 7 basis points, which is a pretty meaningful impact in terms of the average, which is about 26 basis points. Okay.
Sorry, do you have a sense of how much of the variance in CIP you can explain? Just the corner of the envelope? Maybe it's quite large, actually.
So this 10% increase in demand, for example, gives us a sense. But if you're thinking about it from R-square perspective, for example, if I remember it correctly, this particular table, for instance, has an R-square of 33 to 40%. So we're looking at non-trivial, but not everything, for sure. Yeah. Okay. Now, one important thing that I also show is that this price impact is not limited to quarter ends. It's not driven by quarter ends. Quarter ends are special dates. We know that from the literature. Banks do a lot of window dressing. There's also a steeper supply curve during quarter ends. If I were to drop those periods from my sample, I continue to find a price impact. And intuitively, the price impact is a bit smaller compared to times when we include quarter ends, which also makes sense because at quarter ends, the supply curve is generally much steeper. So that's one interesting takeaway from these results. Okay, so I have only a couple of minutes left. I want to very briefly talk about one macro level implication, which is the use of central bank swap lines. Central bank swap lines, they were introduced as emergency facilities back in the financial crisis. And what this plot shows is the drawdown of these facilities by foreign central banks. This is at a monthly level. They're obviously used quite extensively during financial crisis, for example, 2008 to 2012, including the Eurozone crisis, as well as the COVID period. But interestingly, they're also used extensively outside of crisis periods. In particular, in the months following COVID, we do have very regular drawdown of central bank swap lines. This is a specific time when the central banks, the Federal Reserve and European Central Bank, for example, they have to step in to provide dollar liquidity. What I'm going to show you here is this combination of wholesale funding constraints and expensive synthetic borrowing helps us better understand the drawdown of central bank swap lines. So I'm going to regress the drawdown of central bank swap lines on my instrument, which is excess wholesale funding, interacted with the cross-currency basis, which captures the cost of synthetic funding. Okay, we'll control for all the standard variables and add fixed effects. First, my instrument standalone negatively correlates with the central bank swap line drawdown, which means that when wholesale funding is tighter, banks increase the drawdown of central bank swap lines, which makes a lot of sense. Likewise, if you look at the cross-currency basis standalone, it also negatively correlates generally with the use of central bank swap lines, which means that when synthetic markets are more expensive, banks have to use swap lines. But it is the interaction of the two terms which is economically most important in terms of the size, which shows that when both funding markets are tight, you have a decline in wholesale funding interacted with more expensive synthetic funding is when banks significantly rely on swap lines as a source of dollar funding. And this highlights that these funding frictions are not limited to these private markets. They can have macro level implications in the ways central banks have to react. All right, so I'm out of time. So I'm just going to quickly talk about the key takeaway from my counterfactual exercise. There's just one slide on it. What I do in this last part of the paper is try and quantify how much wholesale funding decline would be necessary before banks eventually have to either pass on the cost of increased dollar funding to their end borrowers or even cut down dollar lending. Okay? So on the x-axis, we have the availability of wholesale funding going from fully available to not available at all. And on the y-axis, we have the total amount of dollar funding available to banks from both the funding markets put together. Initially, as wholesale funding goes down, banks are able to substitute to synthetic dollars because it's still not that expensive. But the red dashed line is the threshold at which synthetic dollars become too expensive relative to the revenues that banks make on dollar assets. It is at this point that banks would have to either cut down lending or pass on these costs to their end borrowers. And this counterfactual exercise helps us with certain policy implications on how much slack there is in wholesale funding markets. All right, so I'm out of time, so let me conclude here. This paper is motivated by the growth of synthetic funding markets in the portfolio of large global banks' dollar funding portfolios. And it is the first paper that is jointly looking at both of these funding markets from the perspective of global banks to make three contributions. I show that banks increase their demand for synthetic funding when they face a decline in wholesale funding markets. This demand shift turns the cross-currency basis more negative, effectively making synthetic dollars more expensive. And this combination of a sharp decline in wholesale funding and increased cost of swaps tells us something about the use of central bank swap lines and also potential impact on bank lending. Thanks very much. Looking forward to any further questions or discussion.
Thank you very much, Moang. Thank you for the great paper. Our next candidate is Oliver from Stanford. We're presenting share screen.
Great. Great to see everyone. And let me just kind of jump into it. Okay. And then this should be good, right? So you guys can see this?
Mm-hmm.
Okay, great. I'm just going to get into it. Thanks everyone for coming to this final talk. And so, the final 40 minutes, I'm going to talk a little bit about theory. So I'm going to try to make sure everyone is engaged as much as I can. So my paper is on financial hedging and optimal currency of invoicing. And so in particular, what I study in this paper is trade invoicing. Trade invoicing is a really important subject in international economics. Often in international trade, prices are set in advance, but in a particular currency known as the currency of invoicing. So the invoicing currency often determines the real effect of exchange rates on trade balances. So what I mean by this is that prices, because they're set in advance, but in a currency, they will fluctuate with the nominal exchange rate. So for example, a European producer selling goods in the dollar is going to have their price fluctuate with the dollar exchange rate. And so actually in the trade data, what we know is that the vast majority of trade is actually done in the dollar. In fact, the $33 trillion of annual global trade is invoiced in the US dollar, which exposes countries all across the world to the dollar. Often countries will actually argue that they should peg their own exchange rate, in part because they want to insulate themselves from US monetary policy and dollar fluctuations. So a basic question is, how does foreign exchange financial hedging feed back into the currency of invoicing decisions that we observe in international trade? So what I'm going to argue is that the financial side is quite important. And in particular, what I mean by this is that the currency of invoicing decision is often a source of financial risk. In particular, when prices and quantities are fixed in trade, the exchange rate affects the value of the trade contract. So, for example, a European producer selling goods in the dollar has their value of their trade contract exposed to the dollar-euro exchange rate fluctuation. Firms can often hedge this type of foreign currency exchange rate risk using foreign currency debt, using FX swaps, but often when they do this, they face market power and sometimes have to post collateral requirements. And so the consequence of this is that when there's imperfect foreign exchange financial hedging, the currency of invoicing decision can be used to share foreign exchange rate risk. So this is one of my favorite quotes, and in particular, what it discusses is how Trader Joe's does invoicing. They say that part of the intensive involvement in the buying process is to reduce risk for our vendors. We pay for mustard in euros, the local currency of the Dijon producer, and assume the risk of the euro-dollar exchange rate fluctuation so that folks can just focus on making mustard and thus lowering total trade costs. So the way to think about trade invoicing that I'm going to argue for in this paper is that invoicing is a mechanism for allocating exchange rate risk across a seller and a buyer. In particular, in this case, by promising to pay for the good in the euro, Trader Joe's allocates the exchange rate risk onto its own balance sheet away from the producer and consequently is able to lower total trade costs. So despite this mechanism and how it's often discussed by firms, the classic theory of trade invoicing does not feature financial hedging. In particular, there has been a long literature that has thought about why we observe trade invoicing in one currency versus another, in part because it's central to many of the conclusions in international economics. The leading theory of trade invoicing relies on real hedging, which shows that trade invoicing should only depend on real risks such as uncertainty over costs and demand shocks. So this has been argued by Charles Engel in 2006 and has been repeatedly cited in Burstein and Gopinath and Skokie in 2022. This particular irrelevance result that they often argue will completely decouple trade invoicing decisions from foreign exchange financial market frictions, in particular suggesting that the interest rate of different currencies is not going to feed back at all into the invoicing decisions that we observe in trade. I am going to integrate financial hedging into the existing framework of trade invoicing, and this will help me explain the dominance of the dollar in both trade and financing, and it will help me explain the rise of the renminbi in trade and financing over the past decade. So I want to emphasize that my paper shows a key result that changes many of the normative and classic prescriptions for trade invoicing, which is that foreign exchange financial hedging will affect the choices of trade invoicing that we observe to the extent that trade quantities are in part pre-specified. And I will go through a model to explain why quantities are so important to determining trade invoicing. So in particular, my paper is going to be split up into 3 parts, and hopefully within the 40 minutes, I can get through most of it. First, I will develop a positive theory of trade invoicing that will explain the rise of the renminbi and the existence of the dollar as a central currency. I will show you through an event study that will link my theory with dollar invoicing, that this is an incredibly important channel for understanding the patterns in the data. Finally, I will discuss the normative implications of my model if time permits, and in particular how it changes our understanding of capital controls in general equilibrium.
So have a question. So when you say only when, does it mean that quantities, pre-specified quantities are necessary conditions?
Yes, pre-specified quantities are a necessary condition in order for foreign exchange financial hedging, such as the type that Nicolas was talking about earlier, to then feed back into the invoicing decision. So, in particular, what that implies is that if foreign exchange markets are really messed up, it still won't affect the trade invoicing decision if quantities are ex post determined. And so I'll show you this through the model and tell you why this works in particular. So obviously there's a really long literature on all of these subjects. So I want to think of my contribution as threefold. First, I'm going to link the largest hedging market in the world to real outcomes. I think we all understand that foreign exchange hedging is very important. I'm going to argue that affects real outcomes. The second point is that it's going to help us understand the empirical evidence on the dominance of the dollar in trade and financing and thinking about foreign exchange frictions in particular. Finally, I'll endogenize trade invoicing in the macroeconomy and hopefully give you a sense of why this is going to be important when we think about policy. Great. So I'm going to start by going through a simplified model, in which case I'm going to be able to show for you why quantities are important and how, in particular, foreign exchange hedging frictions are going to affect trade invoicing. Then I will develop a theory of the optimal currency of invoicing and apply my theory to understand the existence of dominant currency pricing. Then I'll talk about an event study that validates my mechanism, and then if time permits, I'll go through the aggregate implications. So just to start off, I'm going to take a very standard model of trade by assuming fixed quantity commitments, uniform pricing, and standard preferences in technology. These are essentially not going to affect the main results, so it's really just to streamline the exposition and make sure that we're all on the same page. So here is the model environment. I have a static model with risk, and in particular, there's risk because there's uncertainty over the states of the world, as indexed by the exogenous vector x. So in particular, the states can vary because there might be uncertainty over costs, demand, exchange rates, etc. For just, concreteness, I'm going to assume that there's a US market that's buying goods from Europe, and this US market, indexed by J, consists of a measure of buyers indexed from 0 to 1. In particular, the buyers all have the same preferences. It's a constant elasticity of demand preference, and the total quantities sold to this US market are going to be the aggregate of all the buyers in that market. I will have a French producer that is going to be selling goods to this particular market, earning profits equal to the price minus the marginal cost times quantities from selling, I'm going to call it mustard, to this US market at the unit price P and the quantity Q. And so for this particular setting, I'm just going to assume that the technology is such that there are constant marginal costs that vary across states, and in particular, this French producer is a monopolist, as is commonly assumed. So I'm going to assume that quantities are going to be in part pre-specified. So the key assumption I'm making is that the buyers in the US market are heterogeneous, and in particular, some fraction delta are going to fix their quantities ex ante, while the remaining buyers determine the quantities ex post, such that the final demand curve, as highlighted here, is just going to be equal to the sum of the two different types of buyers. Now, this is motivated by the fact that in trade contracts, we often observe standalone contracts and master agreements. So the typical analysis is to assume a long-term trade contract where quantities are totally ex post determined as in the master agreement. But actually what we know in the trade data is that more than 50% of trade contracts specify quantities, because you can think of them as standalone trade contracts where Nicolas earlier was talking about how Airbus might have to export a huge plane that takes 1 year to produce and then sell to a foreigner. And so this exposes the producer to these exchange rate fluctuations, fixing the quantity. So I will say that quantities are flexible when they're ex post determined, and otherwise they are sticky. And in particular, I will assume that there are two currencies, just to make it simple right now, the euro and the dollar. I will normalize the first period exchange rate to 1 and then I will denote the dollar appreciation by little s, where s in particular is the nominal exchange rate minus 1. So for example, if s equals 2%, that means the dollar has depreciated 2% against the euro. I'm going to assume that the euro is the numerator for all prices and payoffs just to make sure that we're thinking about everything from the perspective of the French producer. I will assume that euro prices are fixed in advance but invoiced in the share of the dollar. And so what that means is that the realized unit price of mustard is going to depend on the price level and a pass-through coefficient of the exchange rate. So for example, this is saying that prices are sticky in the producer or the local currency. In particular, if I were to set beta equal to 0, you can see that the unit price of mustard is going to be some constant in euros. But if beta equals P naught, then the unit price would move 1-to-1 with the dollar exchange rate. For now, I'm just going to allow it to be anything within the interval from 0 to P naught, but you can obviously relax this.
So is beta endogenous?
Yes, exactly. And so the key is that I'm going to have that the seller chooses the price level and the currency of invoicing and how quantities are determined. So let me formalize that for you. So right now, this is endogenous, and because this choice of the currency of invoicing is made in advance, I need some way of easily understanding how future actions are going to map to present value. And so what I'm going to do is I'm also going to specify stochastic discount factors for the seller and the buyer. I will assume that the seller and buyers have exogenous stochastic discount factors given by MI and MJ. These stochastic discount factors are going to model the marginal utility of wealth in each state and discount future payoffs in the euro. Now, I'm going to assume that there are hedging frictions. So Umang and Nicolas have talked a lot about how foreign exchange financial markets are often imperfect, but maybe the severity of their imperfections might vary across firms. So in particular, I will allow that the seller and the buyer have different marginal utilities of wealth across states. So in particular, MI is going to capture the seller's marginal utility of wealth. When MI increases, that means that the seller values money more in a particular state. There are many micro foundations for why MI and MJ, the marginal utility of wealth of the seller and buyer, may not be equalized in each state. This is a long list of corporate finance results about how maybe there are asymmetric information, there might be collateral costs, there might be trade credit differences, there also might be payment risk, liquidity. These are all standard theories to say that maybe ultimately the seller and buyer may not agree on their marginal utility of wealth in each state. And consequently, they will want to share risk. I'm going to bake in the assumption that they might want to share risk across states and transfer money to and from the two agents. So in particular, what that means is that for the ex ante buyer, the discounted value of trade must exceed the outside option, which is just going to be rewritten by this condition that says that quantities are downward sloping in the expected discounted price of the mustard. Meanwhile, for the ex post buyer, we get the standard downward sloping demand curve in the realized price. So the way to think about this is that if I walk to Trader Joe's and I say I look at the price of mustard, I might just simply walk away with less mustard if the prices increase or decrease. But if I commit to quantities, I need to think about the expected price. And so the problem I'm going to solve is I will have a French producer that will choose a price level, a currency of invoicing, to maximize expected discounted profits. And so to your question earlier, Dongchen, you want to think of the problem as I'm choosing what is the price of mustard and then whether or not I want to sell the mustard in the euro or the dollar. And in particular, when I make this decision, it's going to affect my final profits subject to the discount factor. And in particular, it will affect the final demand for my goods sale and the realized price in each state. So my goal is I'm going to analyze how this particular currency of invoicing decision is going to reflect the ability to commit on quantities. And I will show you that the classic result, which assumed delta equals 0, which is no quantity pre-specification, implied very stringent results about how prices would be set. And I'm going to show you actually that when delta is not perfectly equal to zero, that in general, the cost of foreign exchange hedging is quite important for determining the use of different currencies in trade. So what I'm going to do now is I'm going to formalize the seller's optimal flexible price, develop a model of costly foreign exchange hedging, and then derive the optimal currency of invoicing. In particular, the basic analysis is I want to study the optimal sticky price, and in particular, I want to characterize this beta. Now, what I'm going to do instead is I'm going to go through an intermediate step where I study what would the price optimally be if the seller could set prices state by state. And this will help me characterize the basic trade-offs that the seller is facing. In order to do this, I'm going to linearize the flexible price first order condition around the expected state, and I'm going to tell you what happens. So here is the classic theory of trade invoicing. Now, if you are not paying attention, this is where I really want you to pay attention and follow this closely. So in the classic theory of trade invoicing, the cost is going to fluctuate with the aggregate state, causing prices to reflect real risk. So if you look at a standard monopoly pricing problem, what does the seller do? They set prices state by state according to some markup over marginal cost. And so in particular, this price that they want to set is going to reflect the real risks of trade, such as whether or not costs have appreciated for red wine vinegar, which is an input into mustard. Now, this assumes that there's no quantity commitment. Suppose you have quantity commitment, then the optimal price reflects financial risk. And this is the key result of my paper. In particular, in states in which the seller has a higher marginal utility of wealth than the buyer, then the seller will want to raise prices against the buyer. Vice versa, when the seller has a lower marginal utility of wealth than the buyer, they will lower prices. And the intuition for this is that the trade contract is a mechanism for also sharing exchange rate risk. In particular, the seller and buyer can transfer risk from the seller and buyer by raising or lowering prices when there are quantity commitments. And so when we think about the prices that we observe in the data, often they're not just purely for monopoly rent seeking, but they can also be used to share and transfer value from the seller and buyer when there is imperfect markets. What you can see is that the pass-through of this financial risk depends on the seller's profit margin and the degree of quantity stickiness. And so the classic irrelevance result in this literature, which has assumed that there's no relationship between the cost of FX hedging and the choice of pricing, assumes that there was no commitment over quantities. And so the consequence of this is that now we can actually characterize the optimal currency of invoicing. In particular, in order to characterize how a seller would set their prices optimally, what we do is that we project the flex price onto exchange rates. And in particular, what this equation says is that if I want to know what is the optimal currency of invoicing, I simply take that equation I had from earlier, the flex price, and I project it onto the euro-dollar exchange rate. And the reason for this is that if I can't set prices state by state, what I can do is I can use the dollar exchange rate to approximate my desired flexible price in each state. So in order to do this, I need to tell you how does the cost of FX hedging ultimately show up in this formula. And to do that, I need to quickly give you a detour on how to model costly FX hedging, and then I'll conclude with the ultimate result. So here is a standard model of perfect foreign exchange hedging, where in particular, what we have is two standard equations that are hopefully more familiar in international finance. There's a dollar Euler equation and a euro Euler equation. These represent the fact that the seller and the buyer are able to invest in a foreign currency and a home currency bond, which in this case I've denominated as the euro and the dollar. Now, what we can do is actually, we can do some basic math and divide both sides. And what we're able to do is then rearrange to derive what is known as the certainty equivalence of dollar risk. What this equation says is that the cost of exchange rate risk, in this case dollar exchange rate risk, is exactly equal to the interest rate gap between two currencies. And the intuition for this is that if I can invest in the euro at 4% and the dollar at 5%, then that 1% gap that I'm leaving behind must be accounted for by the cost of exchange rate risk. By no arbitrage in a model of perfect foreign exchange hedging, we know that this exactly pins down the forward rate. In particular, the forward rate equals this interest rate differential after normalizing by the exchange rate. And so I'm going to now define the following object, which is in the frictionless benchmark, we know that the forward rate exactly equals the certainty equivalent of the dollar risk. And I'm going to define a model of costly foreign exchange rate risk as given by the same equation, except I've replaced the SDF with simply the seller's SDF and the buyer's SDF. And what this represents is I'm going to call this the seller and buyer's effective forward rate. This represents the valuation of the euro-dollar risk that the seller and buyer perceive when they are choosing different currencies. And in particular, the idea being that, remember our earlier example, Trader Joe says, I'm willing to buy the good in the euro because I have a larger balance sheet capacity for managing that exchange rate risk. That in this model is captured by the fact that FJ, which is Trader Joe's valuation of exchange rate risk, will be higher than the seller's valuation of exchange rate risk given by FI. There are many micro-foundations for why FI may not equal FJ. The point is that this is a sufficient statistic. In fact, there are many corporate finance models, international finance, CIP. All of these frictions are going to feed back into this particular difference between the seller and the buyer. So now we can derive the optimal currency of invoicing, and I will show you that depends on the cost of FX hedging. Note that the valuations of euro-dollar risk relate to the effective forward rates intuitively. And so when we project the linearized flex price onto the euro-dollar exchange rate risk, we immediately get that that particular risk-sharing term that I was highlighting as the novel contribution of my paper exactly equals the difference between the seller and buyer's effective valuation of exchange rate risk. So when we apply the minimum variance formula, we see that the classic theory of trade invoicing is purely about real hedging. It has nothing to do with the cost of FX hedging. Despite the fact that even if Trader Joe's finds it hard to hedge certain types of exchange rate risk, it does not feed back into their choice of invoicing. However, once we have quantity commitments, we see that fundamentally the choice of invoicing is going to respond to the fact that the seller and buyer may face differential valuations of exchange rate risk. And this is the key result, that to the extent that the seller and buyer do not value exchange rate risk equally, this will tend to push invoicing in different directions. So I don't have a lot of time to go through why this is a more general result, but what
Just a quick question.
Yeah.
Could I interpret the invoicing as, say, a location decision that would behave a bit differently, and then your model would also have implications for how I should look at my plans depending on how much you hedge?
Yeah, so can you explain what you mean by location decision? Because what I have in mind is that, look, if you are in a particular currency union, you just want that type of exchange rate risk much more and that type of home currency bias. Yeah, but what do you...
Yeah, what I had in mind is, say I'm Volkswagen, I could put my plant in Europe or in the US.
Yeah.
Then maybe it's more costly in the US or something like that. But that
Yes.
would be against dollars.
Yeah, exactly. So definitely where you put your plants is going to be really important. And in particular, that will also affect your ability to access cheap currency debt in that particular union, right? So like if I have a subsidiary in the US, it makes it such that the dollar becomes cheaper for me to borrow in, and all else equal, you think that that should affect their choice of invoicing in the dollar. And this is what I'm highlighting, that there's a feedback between your interest rates and also your ability to borrow in different currencies into the choice of trade invoicing. Exactly. So the key takeaway is that quantity commitments connect the fundamental functions of a currency together. What we typically think of as the core functions of a currency are first as a method of trade. In particular, often people say that the unit of account function of currencies is quite important. There's also another type of core function of a currency, which is its use in financing. The dollar is used tremendously in international financing. My theory is reconciling these two core functions of a currency and showing that they're connected to each other through quantity commitments. What happens and what goes wrong when you don't have quantity commitments is that Trader Joe's can simply say, I will reduce my demand whenever the euro has appreciated. The consequence of that is that it breaks down the risk sharing arrangement. So what's important is that the seller and buyer are able to commit to quantities, and that causes trade and use of currencies in trade to be fundamentally connected to the use of currencies in trade. In financing, sorry. Okay, let me quickly illustrate the implications of my theory for producer, local, and dominant currency pricing. So what I'm going to now do is I'm going to switch the setting into a particular economic environment of my event study that I will show you later, and I will use my theory to actually do multiple currencies. I just didn't show you that particular part to make sure that things are very simple. In particular, I have a Korean exporter selling goods to a Chinese importer, choosing the won, the renminbi, or the dollar. And I will assume that marginal costs can be in the dollar and that there is also an incentive for financial hedging, where the importer cannot hedge their dollar exchange rate risk and prefers to pay in the renminbi, then the dollar, then in the won. So I want you to think of this as a small Chinese importer who simply cannot hedge these exchange rate risks because there's insufficient liquidity and they cannot post collateral. So I want you to move away from, Nicolas's setting where he was looking at large multinationals. I'm looking at a small, medium-sized importer. Here is how the different pricing regions would show up as the optimal currency of invoicing. This graph is a lot to digest, so I'm actually going to work through some examples. But basically, what I have here on the y-axis...
Sorry, can I ask a question?
Yes, please.
Yeah, but still in this example, you're assuming that the Korean exporters are monopolists, right?
So that's just because it's the standard assumption in the invoicing literature. You can actually relax that, and it won't really make a huge difference.
I see, okay.
Yep, great. So the y-axis is the degree to which the Korean exporters' inputs are in the dollar versus in the won. And then the x-axis is the degree to which I assume that there's quantity stickiness, which is to say that they can commit on quantities. So here is how you read this graph. This is kind of confusing. So here I have producer currency pricing, dominant currency pricing, and local currency pricing. Suppose I were to take a seller and buyer pair where the producer, the Korean producer, has 80% of their inputs in the won and only 20% of trade is pre-specified. Then what they choose is the won. And the reason why is because most of their inputs are in the won, so they will want to pass on that risk and sell in the won. Now, suppose instead I were to move down and look at a different seller-buyer pair who instead have 50% of their inputs in the dollar. Now you can see that they're going to switch from the won to the dollar. This is all real hedging. However, notice that if I make quantities much more sticky, instead they're going to switch to the renminbi as a form of risk sharing between the seller and buyer. In particular, the Chinese importer really doesn't want to pay out in the won. It's just really hard for them to acquire. It's very costly, that exchange rate risk. And so what happens is that the seller assumes that exchange rate risk away from the importer's balance sheet to the extent that quantities are pre-specified. But of course, if you have a producer that uses entirely dollar inputs, like think of Samsung, they have to import all of their chips from China, from Taiwan, and from the US, then what they're going to do is they're going to still sell in the dollar. And that's because so much of their inputs are in the dollar that they want to pass on that exchange rate risk.
Oliver, how do we think about like another strand of literature also endogenizing the input currency?
Yeah, totally. I think that's a really interesting part, and that's exactly what I'm trying to highlight here. I'm writing down a model in which you have both the concept of real hedging, which is your inputs and where you source them from, and the financial side. I actually think as I read more and more about how firms make invoicing, that it's actually not all about the financing side. A huge part of it is exactly, I will source my inputs in a particular way, and I will try to pass on that risk. And this makes global value chains really interesting because say I'm a huge global value chain and I have tons of inputs all across the world, then that will tend to strengthen the fact that I want to sell goods in the dollar. So here is what happens if I were to allow the seller and buyer to be able to easily access FX forwards. This is the world in which there are no financial frictions, and consequently financial hedging goes to zero. What you can see is that actually the optimal choice of invoicing will only depend on real hedging. So in other words, this financial hedging mechanism that I highlight is really about differences between the seller and buyer's ability to access FX contracts. Once they are both large producers, for example, with multiple banks, you can see that the choice is mostly determined by the real side. So here is an example where I do a comparative static where I actually subsidize the exporter's renminbi forward rates. And the reason I'm going to do that is I'm going to show you an event study where in particular, this will cause a huge increase in the renminbi shares. So this is what happens. This is the baseline model that I showed you. And then this is what happens if I say Korean exporters, you get a subsidized renminbi forward rate. And this is going to make you want to hold that renminbi exchange rate risk more. How does that affect the optimal currency of invoicing? What you can see is that after this particular subsidy, there's a huge policy region that has now switched from dollar invoicing to renminbi invoicing. I will show you in a second that the way we understand the rise of the renminbi and the use of the dollar in trade and financing is ultimately about the financial hedging channel. So here is an event study that I'm going to walk you through where I show how this financial hedging channel it can be causally identified and affects the invoicing patterns we observe in the data. So in particular, there has been a transition from dominant currency pricing to local currency pricing in the data, where in 2014, the Korea-China summit established a direct foreign exchange market between the won and the renminbi in Seoul. Here are the aggregate invoicing patterns for Korea. Already you can see that the dollar is extremely important in Korea. Despite the fact that Korea is not obviously the US, they tend to almost sell all of their goods in the dollar. Now, what you can see is that when you break down the other section, that in 2014 there was a rise in the renminbi. I'm going to now show you why I think this particular rise is a story of financial hedging. Here is a quote from Goldman Sachs that I had to work so hard to find because I basically had to ask all my Goldman Sachs friends, begging them for this quote and actually finding the source material. This is what Gu-Hoon Kwon, the managing director of Global Investments Research, says about this particular exchange rate market. He says that we see several supporting cases for the creation of a yuan-won market in Korea. First and foremost, a CNK market would facilitate yuan settlement in bilateral trade, which would help turn Korean exports to Chinese domestic markets by removing currency risk for Chinese importers. He in particular says that this is especially important when the importer in China is a small and medium-sized importer who tends to face difficulty in hedging their currency exposure. So what you can see is that by establishing this offshore CNK market, what happened was that the seller increased their valuation of exchange rate risk in their renminbi Korean won leg, but the importer was not affected because of capital controls. This increases the incentive for renminbi risk sharing, which through the lens of my model causes more renminbi invoicing. And this is what you see in the data. In particular, the blue line is the share of renminbi exports in percentage points from Korea to China. The red line is a synthetic control that is constructed using other exporting shares in different currencies to all other regions for local currency pricing, dominant currency pricing, and producer currency pricing. And in particular, what you find is that by establishing this exchange rate market and increasing the use of a currency in financing, you then get an immediate feedback into trade. And if you look at the invoicing patterns typically in the data, they rarely change so dramatically and so distinctly. And so the way to think about invoicing, as I show, is that a use of a currency in finance ultimately affects its use in trade. Okay.
Sorry.
Yeah.
Quick question. On this, you're thinking the Korean firm taking advantage of this, like they hedge the exchange rate risk, and therefore they are more willing to invoice in renminbi.
That's exactly right. Yep.
The Korean exporter.
Yeah, the Korean
Okay.
exporter. Yeah.
Okay.
So there, I think there's another paper by Salim and Ricardo talking about like jump starting the
Yes.
international currency.
Yeah.
In their model, they're also talking about invoicing, but indeed they have flexible quantities, but they have some mismatch between input and output. What I mean by mismatch is that they have to pay the input with borrowing before their output is realized. So they have some like mismatch in timing, and then because of that,
Yeah.
they have a demand for financial hedging,
Yeah.
and specifically because of the borrowing cost. So how do you reconcile
Yeah.
that?
Yeah, so I would have to read the paper carefully but just from first impressions, when you have a quantity constraint that is created ex ante because of some like liquidity need or things like that, it essentially produces as if pre-specified quantities because it forces you to take on a position and capture the fact that there's some risk sharing benefit. So you can see in my model, I mean, you can actually generalize it. My result is true across all models that you've written down. So if there is this particular force in their model, it must be that somehow this constraint acts as if you pre-specified quantities. Yep. So I think I only have 4 minutes or 5 minutes, so I'm just going to walk you through really quickly the big picture of why this is important. In particular, I want to argue that dollar financing is tied to dollar trade and that you can't think about these things differently. And then I'll conclude and I'll, just summarize my paper. So in particular, this is really important. This particular theory of trade invoicing is important because it changes our fundamental understanding of macroprudential policy. Actually, in the IMF, they often support the use of foreign currency capital controls in order to fight something known as original sin, which is the tendency that countries will borrow too much dollar debt. For example, Brazil actually uses IOF taxes in order to regulate the amount of dollar debt that's in their system. I'm going to argue that these types of regulations are totally counterproductive and can often backfire the moment you think about the aggregate relationship between trade and financing. And the reason for this is the following. If you think of what dollar capital controls are, they're essentially causing a tax on local agent dollar debt. It's a method of reducing the amount or desirability of borrowing in the foreign currency. If you do this, what happens is that you're essentially raising the after-tax yield of the Euler equation. So if you were to take the Euler equation that I wrote down of the producer or the buyer, what you're essentially doing is you're throwing in a wedge to say, I don't want you to borrow in the dollar. But of course, that's now going to show up in the optimal currency of invoicing. You can see that the optimal currency of invoicing, in particular the amount of dollar trade, responds endogenously to the fact that capital controls have made financing more expensive. And so fundamentally what that means is that when you try to regulate dollar borrowing, you actually increase dollar trade. And why is that? My paper is essentially showing the following basic result. Trade contracts are IOUs. What that means is that if I enter into a dollar trade contract, I've essentially written a synthetic dollar liability, and so consequently, trade contracts are substitutes for dollar financial debt. When a government tries to tax dollar borrowing by using capital controls, it actually increases dollar trade. And obviously, this can be very counterproductive because ultimately it can lead to recessions. Okay, I'm out of time. I don't want to thank you everyone for coming, and it's so late for many people. So I just wanted to conclude. My paper formalizes the endogenous link between a currency's unit of account and its financial functions. I show that financial hedging depends on quantity commitments and imperfect foreign exchange markets, and in particular, I fundamentally demonstrate that the use of a currency in trade and the use of a currency in financing are linked when quantities can be pre-specified. Thanks, everyone.
Thank you very much, Oliver. Thanks so much for sharing this great paper with us. This concludes our international finance section of the IMIM Rising Stars workshop. Tomorrow we will have Steve Wu chairing the international economics session, which we also have 4 Rising Stars candidate in international macro. So thank you very much. Thank you, Oliver, Umang, Nicolas, for joining us and presenting their excellent papers, and all the best of luck for your job market.